All right, let's talk about something that can really trip people up in retirement: annuities. Specifically, we're diving into a hidden fee that can feel like a trap for your savings. It's called a surrender charge. And trust me, if you're not paying attention, it can take a serious bite out of your money. So we're going to break down exactly how to spot it and how to avoid it. So just imagine for a second, you need to get to your retirement cash, but surprise, you find out that just taking it out is going to cost you a massive penalty. We're talking 7, maybe even 10% of your money gone. That's the fee we're tackling today.
Here's the game plan. We'll start with what these charges even are. Then we'll get into how they work, and most importantly, how to get around them. After that, we got to talk about taxes, and then we'll wrap it all up with the key takeaways you need to remember.
Okay, first things first, what in the world are surrender charges? Let's pull this whole concept apart so you know exactly what you're up against. In plain English, a surrender charge is just a penalty for cashing out your annuity too early. Insurance companies set up what's called a surrender period. It's a specific number of years where these fees kick in if you try to pull your money out ahead of schedule. Now, I know what you're thinking. That sounds pretty unfair. But here's the other side of the coin, from the insurance company's perspective. For them, these fees are actually a protective measure. They need to keep a big, stable pool of money to make sure they can deliver on those guaranteed payouts for everybody, not just one person who wants to cash out early. So really, it all boils down to a few things. These charges stop a mass rush for the exits, which keeps the company financially stable. They also help the insurer get back the money they spent up front, things like the commission paid to the agent who sold you the policy. And it lets them make the kind of long-term investments they need to fund everyone's retirement down the road. So we get the what and the why. Now let's dig into the how. How do these charges actually work during that so-called lock-in period?
This is a super common example. You can see the penalty is at its highest in year 1, a painful 7%, and then it gradually drops by 1% each year. By the time you get past year 7, poof, the charge is gone. Your own contract will lay out the exact schedule, and they can last anywhere from 3 to 10 years, sometimes even longer. But here's some good news. You're not completely locked in. Most contracts have a little bit of wiggle room built in, and it all revolves around this one number: 10%. Yep, that 10% is your penalty-free pass. Think of it as your annual allowance. It's a really key feature that gives you some access to your cash each year without setting off that big surrender penalty alarm. And this is a really important point. You have to understand the difference between a withdrawal and a surrender. A withdrawal is just taking a slice of the pie, and it can be totally penalty-free if you stay under your limit. A full surrender, on the other hand, is when you cancel the whole deal. That's the move that triggers those hefty fees we've been talking about. And just a heads up, surrender charges aren't the only thing hiding in the fine print. You've got to watch out for stuff like market value adjustments or MVAs, where your payout could actually shrink if interest rates have changed. Some contracts have a bonus recapture, which means you might have to give back that nice sign-up bonus they gave you. And taking money out early could even mess with other benefits, like an income rider you paid extra for. Okay, let's get to the part you've been waiting for. How do you actually avoid paying these fees? Let's talk about your escape routes. There are really 4 main strategies here. The absolute best one is to plan ahead before you even buy and make sure the surrender period lines up with your life goals. If you're already in a contract, always use that free withdrawal allowance first. The simplest strategy, if you can swing it, is just to wait it out. And finally, see if you can get a waiver. A lot of contracts actually have these built-in escape hatches for major life events. We're talking about things like being confined to a nursing home, getting a terminal diagnosis, or sometimes even losing your job. These can let you get your money out without a penalty. Also, those required minimum distributions, or RMDs, are usually exempt too. Now listen up, because this is a classic trap. You might hear about something called a 1035 exchange, which lets you roll your money into a new annuity without paying taxes. Sounds great, right? But here's the catch. That shiny new annuity, it's going to come with its own brand new surrender period. The clock completely resets. So you figured out how to dodge the surrender charge. You're home free, right? Well, not so fast. There's another penalty lurking out there that you absolutely need to know about: taxes. So you might be thinking, okay, if I do get stuck paying this fee, can I at least get a tax break for it? Can I write it off? And the answer to that is, unfortunately, a very clear and simple no. You cannot deduct them from your taxes, period.
And when we're talking taxes, that number, 10%, is about to make a comeback. But this time, it's definitely not in a good way. That's right. This is the IRS's penalty. If you take money out of your annuity before you're 59 and a half, the IRS is going to slap you with an additional 10% tax penalty on any of the investment gains. And this has nothing to do with the insurance company's fees. It's on top of them. It is a true double whammy.
All right, let's pull this all together. Think of this next part as your master key, your cheat sheet for making sure you never get caught in the annuity trap. So here's your final checklist. First, remember that annuities are long-haul products. Number 2, and this is critical, know your surrender period before you sign on the dotted line. Third, always use that 10% free withdrawal as your go-to move. Fourth, patience really is a virtue here because these charges do eventually go away. And last, never ever forget to account for both the company's surrender fees and the IRS's taxes.
So we started this whole thing by calling it a trap. But now that you know the rules of the game, the surrender periods, the escape hatches, the tax implications, let me ask you this. Is an annuity really a trap? Or is it a powerful financial tool that, now that you're armed with the right knowledge, you can actually master for your retirement?